Okay, Lana, quick question. What company touches nearly every FDA-approved drug, every major vaccine rollout, and basically every lab on the planet, but almost nobody outside of science even knows the name?
That would be Thermo Fisher Scientific. And it's kind of poetic, honestly. They're the picks and shovels play behind modern medicine. You don't see their name on the pill bottle, but without their instruments, reagents, and services, that pill probably doesn't exist.
This is a company doing nearly $45 billion a year in revenue with over 80% of it recurring. Think about that. 80% recurring in a business that enables drug discovery, gene therapy, and precision medicine. Today on Charged Alpha, we are going deep on Thermo Fisher Scientific, ticker TMO. Episode 109, let's get into it. So let's set the stage. Thermo Fisher is headquartered in Waltham, Massachusetts. They've got about 125,000 employees spread across more than 50 countries. They trade on the NYSE under TMO, with a market cap sitting around $184 billion.
And what's important to understand is that Thermo Fisher isn't just one business. It's really four major segments working together. You've got Life Sciences Solutions, which makes the biological reagents and instruments for research, analytical instruments for mass spectrometry, chromatography, and electron microscopy, Specialty Diagnostics covering clinical testing, and then Laboratory Products and Biopharma Services, which is everything from lab consumables to full contract manufacturing for drug companies.
The CEO is Mark Casper. He's been running the show since 2009 and became chairman in 2020. Harvard MBA, started at Bain & Company, and he's executed over 25 acquisitions totaling roughly $68 billion in deal value during his tenure.
That M&A track record is genuinely remarkable. This isn't a company doing one big splashy deal and hoping for the best. Casper has built a systematic acquisition machine, buying companies that expand the platform, integrating them efficiently, and then cross-selling across the installed base. It's a playbook, and it's been refined over 16 years.
Their mission is to enable customers to make the world healthier, cleaner, and safer. And when you look at where their products show up, pharma R&D labs, hospital diagnostic centers, government testing facilities, university research programs, you realize that's not just marketing. That's the actual business.
Let's look at where the stock sits today. TMO is trading around $496 per share. The 52-week range is $385 to $644. So we're sitting roughly in the middle of that range, actually closer to the lower third. The beta is 0.97, which means it basically moves with the market. Not a high flyer, not a defensive hideout.
Average daily volume is about 2 million shares, so plenty of liquidity for institutional investors to move in and out. No issues there.
The stock is down about 23% from its 52-week high. That's meaningful. And it creates an interesting setup because, as we'll see, the fundamentals have actually been improving. So you've got a divergence between price action and business momentum, and that's usually where opportunities live.
23% off the high on a company that just beat estimates 4 quarters in a row. That's the kind of disconnect that makes you lean in.
All right, let's get into the numbers. Full year 2025, Thermo Fisher posts $4.56 billion in revenue. That's up about 4% year over year. Adjusted earnings per share came in at $22.87, up 5%. Not explosive growth, but this is a mature, high-quality compounder. 4 to 5% top-line growth at this scale is actually impressive.
And the trajectory is what matters here. If you look at the quarterly progression through 2025, revenue went from $10.36 billion in Q1 to $12.21 billion in Q4. That's an acceleration through the year, not a deceleration.
Exactly, and they beat analyst estimates in every single quarter last year. Q4 was the standout. EPS came in at $6.57 versus the street's estimate of $6.43, and revenue beat by $270 million. That's not a rounding error. That's genuine outperformance.
What about margins? This is a company with a lot of moving parts. How does the profitability picture look?
Gross margins are running around 41%, operating margin about 17%, net margin is north of 15%. Those are solid numbers for a company at this scale with both product and services revenue. The gross margin is lower than some peers because Thermo Fisher has a large consumables and services business that naturally carries lower gross margins. But those are the most recurring and stickiest revenue streams. So it's a trade-off I'd take any day.
ROE is about 13%. How should investors think about that in context?
13% ROE for a company with $51 billion in equity and $35 billion in debt is respectable. The interest coverage ratio is nearly 20 times, so the debt is very manageable. And free cash flow, which is really the number that matters, came in at $6.29 billion on a trailing 12-month basis. That's a free cash flow yield of about 3.4%, which is right in line with Thermo Fisher's 10-year median. The company is a cash machine.
Let's talk balance sheet. Total assets of $103 billion. Total debt at $35.5 billion. Total equity at $51.2 billion. That's a debt-to-equity ratio of about 69%.
The balance sheet is solid but not conservative. That debt level reflects the aggressive M&A strategy. They just dropped $9 billion on Clario, which we'll talk about. But with $7.8 billion in operating cash flow and nearly 20 times interest coverage, servicing that debt isn't even remotely a concern. They've got about $22 billion in short-term assets to work with.
So it's levered for growth, not levered out of necessity. There's a big difference.
Now here's where it gets exciting. Let me walk through the 4 major growth catalysts I see for Thermo Fisher over the next 3 to 5 years.
Let's hear catalyst number 1.
Cell and gene therapy. This market is projected to grow from $12 billion in 2025 to nearly $20 billion by 2030. That's a 10.6% compound annual growth rate. Thermo Fisher just launched several platforms targeting this space: Gibco cell therapy reagents, Chovantage biologics tools, and the CTS Compleo automated fill and finish system. They also opened a second Advanced Therapies Collaboration Center in Philadelphia. They are positioning themselves as the end-to-end partner for cell therapy manufacturing, and that is a high-margin, high-growth opportunity.
Catalyst number 2, the Clario acquisition. This is the big one.
Right. Thermo Fisher announced they're acquiring Clario for approximately $9 billion. Clario is a clinical trial data and endpoint management platform that has supported roughly 70% of FDA drug approvals over the past decade. This adds a digital data layer to Thermo Fisher's portfolio. Year 1 accretion is estimated at 45 cents of adjusted EPS, and they're targeting $175 million in operating synergies by year 5. It deepens the moat by making Thermo Fisher even more embedded in the drug development workflow.
And then there's the biopharma outsourcing trend and the pharma spending recovery. Catalyst 3 and 4, and they're connected. Large pharma companies are increasingly outsourcing development, testing, and manufacturing to specialists like Thermo Fisher, and at the same time, overall pharma spending is recovering after a period of caution.
The competitive moat here is one of the widest I've seen in healthcare. Let me break it down. First, switching costs. Thermo Fisher's instruments and reagents are deeply embedded in customer workflows. Pharmaceutical companies validate their entire manufacturing process around specific equipment. Switching means revalidation, retraining, potential regulatory delays. The cost of switching is enormous, not just in dollars, but in time and risk.
It's like the ultimate lock-in. Once you're in, you're in.
Exactly. Second, the recurring revenue model. Over 80% of revenue comes from consumables and services. That's the razor and blade dynamic. You sell the instrument, that's the razor, and then you sell reagents, maintenance contracts, and calibration services for years afterward. The instrument sale might be a one-time event, but the consumables stream can last a decade or more.
And third, there's the sheer scale. No one else has this combination of breadth across instruments, reagents, diagnostics, and contract manufacturing. Danaher is the closest competitor, but even they don't match Thermo Fisher's full platform.
Scale is the multiplier. It lets Thermo Fisher invest more in R&D, negotiate better supplier terms, and cross-sell across the platform. When a pharma company is already buying reagents and lab equipment from you, the incremental sale of contract manufacturing services becomes much easier. The ecosystem creates a gravitational pull that smaller competitors simply can't match.
Let's put TMO side by side with the peers. How does it compare to Danaher, Abbott, and Agilent?
Starting with valuation, TMO trades at about 28 times trailing earnings and 19 times EV to EBITDA. Danaher is significantly more expensive at 41 times earnings and 22 times EV to EBITDA. Abbott is similar to TMO at 28 times earnings, but cheaper on EV to EBITDA at about 16 times. And Agilent looks cheaper at 25 times earnings, but is actually pricier on EV to EBITDA at 25 times.
So TMO is in the middle of the pack on valuation. Not the cheapest, not the priciest.
On profitability, Danaher actually leads in gross margin at nearly 60% compared to TMO's 41%. But remember, TMO's lower gross margin reflects its large services and consumables business, which is actually a strength for revenue durability. Where TMO shines is ROE at 13% versus Danaher's 7%. And TMO generates the most free cash flow in absolute terms at over $6 billion. Agilent has the highest net margin at nearly 19% and the best ROE at almost 25%, but it's operating at 1/7 the scale.
So the takeaway is TMO gives you the best combination of scale, reasonable valuation, strong cash generation, and growth optionality. Danaher is the quality premium play, Abbott is the value play, and Agilent is the small cap efficiency leader.
Wall Street is firmly bullish on TMO right now. 19 analysts cover the stock, 1 strong buy, 18 buys, and just 2 holds, 0 sells. The average price target is $639, which represents about 29% upside from current levels.
That's a pretty wide gap between price and target. Any notable calls?
KeyCorp has the highest target at $750. Stifel is at $700. Goldman Sachs initiated coverage in January with a buy rating and a $685 target. Citigroup upgrade to buy also in January at $685. HSBC went to strong buy in December. There's been a cluster of upgrades following the Q4 results, which suggest the street is starting to price in the growth acceleration story.
When you see Goldman, Citi, and HSBC all move to buy within the same 2-month window, that's a signal. That's institutional conviction building.
No honest analysis is complete without the risks, and TMO has some real ones. The biggest near-term headwind is tariffs. In Q4 2025, management estimated an impact of negative $400 million in revenue and negative $375 million in adjusted operating income. Those are not small numbers.
And there's the China exposure. How material is that?
China represents about 8% of TMO's revenue. The combination of trade tensions, economic slowdown in China, and pricing pressure makes that a meaningful risk. Management is investing $2 billion in U.S. manufacturing and R&D to partially offset tariff exposure, which is the right strategic response, but it takes time to materialize.
And then there's the NIH budget uncertainty. Thermo Fisher has meaningful exposure to academic and government customers who depend on federal research funding.
That's estimated at roughly $500 million in revenue pressure from academic and government customers. Until the NIH budget is finalized, that segment will remain cautious. And the Clario integration is the other risk I'd highlight. $9 billion is a big bet. The clinical data and AI culture is different from Thermo Fisher's hardware roots. Execution here is critical, and synergy targets of $175 million by year 5 are ambitious. If integration stumbles, that's a drag on both earnings and management credibility.
Let's look at execution over the last 4 quarters. Because you can have all the catalysts in the world, but if the team can't deliver, it doesn't matter.
Thermo Fisher has beaten earnings estimates in all 4 quarters of 2025. Q4 was the highlight. EPS beat by 14 cents, and revenue beat by $270 million. Q3 was strong with a 5% EPS beat. Q2 saw nearly a 6% EPS beat. Even Q1, which was the softest quarter, still came in above consensus. The consistency here tells you this management team knows how to set expectations and exceed them.
4 for 4 on earnings beats. That's the kind of reliability that institutional investors build positions around. All right, Lana, bring it home for us. What's the verdict on TMO?
Thermo Fisher is a best-in-class compounder trading at a discount to its intrinsic value. You've got a wide moat, 80% recurring revenue, accelerating growth through 2025, 4 consecutive earnings beats, and multiple structural tailwinds in cell therapy, clinical digitization, and biopharma outsourcing. The risks are real: tariffs, China, and integration execution. But they're manageable for a company generating over $6 billion in free cash flow with 20 times interest coverage. At 20 times forward earnings, with analysts seeing 29% upside, this is one of the most compelling risk-reward setups in healthcare right now.
I love the framing there. It's not a moonshot play. It's not speculative. It's a company that enables the entire life sciences ecosystem. And right now, the market is giving you a chance to own it at a meaningful discount.
And the closing thought from CEO Mark Casper puts it perfectly. He calls Thermo Fisher an innovative powerhouse building bridges between scientific potential and technological realities. With cell therapy inflecting, biopharma outsourcing accelerating, and $9 billion of strategic M&A in the pipeline, that bridge has never been more critical or more valuable.
That's a great note to end the deep dive on. That's going to do it for episode 109 of Charged Alpha. This has been a deep dive into Thermo Fisher Scientific, ticker TMO. And hey, if you want to run the same research workflow we use to build these episodes, head over to chargedalpha.com. You'll get our analysis tools, our research templates, and access to our full episode archive. That's chargedalpha.com. Until then, I'm Hudson Thomas.
And I'm Lana Chen.
Stay curious, stay invested. We'll see you next time on Charged Alpha.
This podcast is for informational and educational purposes only. Nothing discussed on Charged Alpha should be considered investment advice, a recommendation, or an offer to buy or sell any security. We are not licensed financial advisors, and all opinions expressed are solely those of the hosts. Investing involves risk, including the potential loss of principal. Always do your own research and consult a qualified financial professional before making any investment decisions. All financial data referenced in this episode is sourced from publicly available filings, earnings reports, and third-party financial data providers. This episode was produced with the assistance of artificial intelligence tools, including AI-generated research summaries, script drafting, and audio synthesis. All content has been reviewed for accuracy, but listeners should independently verify any data before acting on it.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.